Hey, welcome everyone to another episode of the Unlocked Podcast, where we are three business owners from across the entire globe, centrally located on the North American continent. But we are focused on discussing the experiences that we've had in the lock and security business and growing small businesses to the size that they are now, which is what? Medium. Anyway, we're sharing our experiences with you, good, bad, and indifferent, and excited to have another conversation today around when it makes sense to borrow money. And really, the biggest question around it is, what is the actual cost to borrow money for your business? So my name is Chad Lingefeld. I'm from Lockdock Security in Charlotte, North Carolina. I've got two amazing individuals that run almost as good businesses in their regions. So take it away, whoever wants to go next.
I am Tony Hokinson in Minneapolis, Minnesota with Assured Security. And that was one of the nicest and worst things you've said about us, I think, all in one, you know?
That's not even nearly the worst.
That's true. It's not even near as worse, but
yeah,
you know.
That was rather on brand.
Yeah.
Lars Johnson from Calgary, Alberta. We went in order of usefulness there. So we'll bring it back to the top, Chad. Are we having a doorknob finance class today? Is that what you want to talk about?
No, I will.
Is this NPR? Can we get Tony doing this?
Hello. Yes, welcome to another episode of the Unlocked Podcast.
The Unlocked Podcast.
Speaking of Tony,
all fun.
I got an opportunity. I invited myself to Tony's quarterly company business meeting yesterday, virtually. It was a very cool experience. I told him yesterday on the phone, I was like, we've had a lot of other businesses visit our company and come to our business meetings, and I've never been invited to anybody else's meeting. So
I thought about that comment,
and I didn't get invited to Tony's either. I just invited myself.
So I thought about that comment after the fact, and I was like, I don't know that you ever invited me to your meeting either. I think I was just like, hey, I'm coming to town. Can I come to your meeting? So, you know,
I don't think that's true.
I think it might be.
But Tony did a fantastic job. His team does a fantastic job preparing for the meeting. And I thought Tony did a really good job getting up there and presenting his information, the numbers, the metrics, the KPIs that they're focused on for the business. And it was a really eye-opening meeting. So
I just pictured Tony going through the numbers saying, you know, this one's 12.4768%. And this one is
that's a fact.
I do have more social awareness than you would think.
He only had one decimal point.
Only one?
Yeah. No, I had no decimals.
You rounded to a decimal out of
I had 0 decimals. Okay,
but I did say this. I was like
0.6 repeat percent.
I realized that regionally we all have different accents, dialects, I don't know, and so ours is obviously very southern. I don't hear it all the time because I'm embedded into it, but I said Tony, even when Tony is with his crew, he gets even more Midwestern.
The
numbers here on the quarter. Yeah. That's what we're going to do, guys.
Guys. Hi there. How you doing there, Chad? Oh yeah, Chad. How's North Carolina then there, Chad?
Oh, it was great. So
it does sound like a hoot. But so is it like your quarterly meeting, Tone?
Yeah, so we do a quarterly town hall offsite.
Offsite. Okay.
Yeah.
With everyone, or is that management?
Everyone. So we do a quarterly company meeting because we do not have space for all of our staff. So
you have the world's largest building. How do you not have space?
You've been here. It is not that large.
It's a huge building. You just have 10,000 bedrooms.
Yeah, right. Exactly. That's an accurate description. Yeah. So yeah, we do a quarterly town hall offsite meeting. Half-hour breakfast and then an hour and a half meeting. So it does get a bit long, for sure. But it is quarterly, so we try to deliver as much value as possible. And it's a fun event.
Is it more this is what we did, or is it this is where we're going, or is it a bit of both, or is it
it's a little bit of both? So we start with some highlights from the previous quarter. And then go into kind of managers talk a little bit about what their team's focused on. We do typically 2 to 3 job highlights. And then I end with what are our priorities for the quarter. So our January meeting, I will be doing a little bit more of like vision strategy type stuff. Quarterly, it's more about priorities and just kind of celebrating wins, sharing some facts. We've always got good feedback on doing job highlights at those, and so we try to make that a prominent feature because it is the 4 times a year we all get together in the same room, and going over job highlights is a lot better in a group setting than it is in a newsletter. So
yeah. I also have some exciting news. Couldn't figure out my lighting here. I've been asking you guys about my lighting and why it looks so dark.
Yeah.
Turns out just my monitor settings were turned down.
Oh, well, that's
turned up the lighting for the monitor, and turns out my lighting's fine. So, I had a big week too.
Oh, sounds like it. Jerry. Wow.
Good things.
That's the most you've gotten done in a while.
There you go. That's the content you deserve on the Unlock podcast.
Absolutely.
Oh, fun stuff. Okay. So getting into the topic for today, I've been having a lot of conversations around this. And so I thought this would be hopefully informative for me. So I've got a lot of questions to ask, but over the course of the past few episodes, we've been talking about lead and lag measures. We talked about kind of breaking that $3 million barrier. We talked about like at what point in time do you try to take on larger projects and to try to scale? What are all the elements around that? And a lot of that has come down to some conversations we've been having internally with our business and looking at what is the actual cost of debt or the cost of borrowing money. Because I think that there's an element in there of some opportunity cost. If it requires us too long to be able to purchase product, or too long to be able to purchase equipment, or whatever, how do we start to leverage some debt to be able to grow? And thinking back through a lot of the books that I've read over the years, you've got the Rich Dad Poor Dad. You've got a lot of these different financial literacy books that talk about how do you leverage debt, how do you not use debt, how do you cash flow everything? Is it, where is the cost benefit? And then on top of that, if you are having to cash flow everything, what other things are you missing out on because you're deploying a lot of cash out and waiting for it to come back? So that's kind of the conversation. And if you guys need any more kind of clarity where my brain is there, to just kind of talk through it, how you guys are seeing things and how you've applied different tactics in your businesses that may be relevant. And again, I always try to think about this from a scale perspective. When we were a $3 million business and we were cash strapped for everything that we needed to do, even at a $5 million business, cash strapped, how do you how do you make those decisions to be able to unlock the next level of growth?
I think this is a good conversation because there's a lot of different philosophies around debt. Good. Like you hear Dave Ramsey is one that specifically says no debt. Do not do debt. Debt is bad. Like you read his book, he talks about the fact that they did everything with zero debt. He is a strong advocate for just don't do it. And then you have the complete opposite philosophy of like, let's grow fast, let's be fast and loose, let's get as much debt as possible, let's leverage ourselves and grow quickly. So I think it's going to be interesting to hear what everyone's take is on this because there's a wide range of philosophies around it, and I don't think there's a wrong answer. But it's more about understanding.
The extremes.
It's more about understanding your risks. Yes. I mean, clearly Dave Ramsey's doing just fine, and he's never used debt. So I would say that that's a far more conservative approach. But I think it comes down to understanding what you're using the debt for. Right? There's good debt and there's bad debt. Are you taking on debt to go buy vehicles maybe that aren't necessary, boats? Are you buying assets that you're going to then get more money back from when you're using that debt? What are you using that debt for? Are you using it for furniture? That is an asset, but it doesn't really produce more revenue. Or are you using it to go buy another business or a building that is going to be able to cash flow positive and generate additional revenue? So I'm excited.
Yeah, I think the two different philosophies. Lars was trying to jump in there, and I was giving him a breath so that he could get back in, but he didn't. So
no, I'm just drinking this all in. The financial gurus here.
No, definitely not a financial guru. And here's the thing: like to Tony's point, you have the Dave Ramsey very tightly conservative model, cash flow, everything, and
generational thing. Yeah,
not to be political, But you have the Trump philosophy, which he was everything was leveraged against everything. Yep. It was a big house of cards. At what point was that going to work or not work? And I mean, there are some results there. And then you have the Rich Dad Poor Dad book philosophy, where exactly what Tony was just talking about is some people purchase liabilities and some people purchase assets. Mm-hmm. And so where is the play to leverage debt on both of those things? So Lars, you have had a few rounds with this over the years. What give us some of your perspectives on what we're talking about here?
Yeah, first I'm going to say it's generational. Most of our parents grew up post World War II. Things were tight, saved food. Consumerism wasn't as strong as it is now. Save for a rainy day was just the philosophy, because that's, their parents grew up in World War I, dirty 30s, and it was just a mentality. So that's what they were taught. And probably your parents and my parents, taught us, generally speaking, save for a rainy day. Debt is bad. Mm-hmm. Debt is bad. That's all there is to it. And I think Ramsey, I'm not sure I believe Ramsey believes what he's saying. I think to a mass audience, I think honestly to a mass audience, I think that makes sense, because the vast majority of people out there, and why I say the vast majority of people out there need that advice. And why do I say that is because I look at the education system and I look at, historically, you learn about math, you learn about social studies, you learn about how to shoot a basketball. You don't learn anything about money.
Yeah, that's
the vast
true.
Majority of people that are sitting here listening to this, all four of them, how financially savvy are they? If, they'd probably put themselves at probably about a 6 or a 7 out of 10, because that's going to be about the average. So, for most people, debt is bad. Yeah. I'm not one of those people. My dad was not one of those people. He talked about leverage and cash flow. And just so we're talking the same definition, leverage means borrowing money or using somebody else's money, which has a cost to it, usually an interest. You pay some interest, but you take their money to buy something else that hopefully produces more than it costs you. So if I can borrow it for 3 and then buy something that makes me 5, that is good leverage. So when we talk about leverage, we're simply just saying taking somebody else's and using it to make some.
So, okay. A great explanation and definition. And I think that's probably part of the segment that I want to grab a hold of, is if I borrow $3 against something that I think is going to make me $5. So I buy something, it's going to make me $5. I am not quite sure, especially those that would be in that, on a scale of 1 to 10 category that you just talked about, anywhere that's 6 or below, what is the delta between the debt service, so the amount that I have to pay to borrow that $3 to the $5 that I'm going to make? And when you say make, are you saying profit on that, or are you saying sell it for $5?
Right. So before even jumping at that, the second term we have to define, so we're all talking the same language, is cash flow. Mm-hmm. Right. So if I borrow $1 million, it's $1 million in debt. Yes, that's simple. But it doesn't cost you $1 million. You have to pay that back per month or per year. Yep. And how much it costs you to pay, that is the cash flow. So the easiest one to think about is just like your mortgage, right? You buy a house for $1 million. You're going to probably put $100,000 down. You're going to have a mortgage for $900,000, and you're going to end up paying much more than $900,000, but you pay it over a longer period of time. Right. So the thing to really think about when you're talking about leverage, when you're talking about debt, we're talking about cash flow. And that's what matters, as long as your cash flow is positive. So
Chad mentioned a really good book on this, The Rich Dad, Poor Dad, and it had a really interesting explanation about the difference between assets and liability. Typically
it's a completely different definition.
Yes. Typically in accounting, an asset is something you own and a liability is something you owe. Rich Dad, Poor Dad outlines that an asset is something that generates cash and a liability is something that costs cash. So typically you would see your house as an asset.
Right.
Rich Dad, Poor Dad advocates that it is a liability because it costs you money. It does not generate a positive cash flow. And I think that was a really insightful way to explain it. That it is acceptable and advisable in many cases to buy cash generating assets. But buying a home, sure, it may be a good investment long term, but it is not advisable to buy too many assets that don't generate cash.
It's not
because it just takes your cash, and you need cash.
There's another thing to, kind of a fundamental about this understanding is, it's risk and return are inversely correlated. They're correlated directly, right? Higher risk means higher return. So, Chad, this goes back to what you were asking about that delta.
Mm-hmm.
The way I look at these things is, why does a bank give you interest rates on a house that's quite low?
Mm-hmm.
They'll give you a 2 or 3% mortgage, right? Or probably 4.5% these days.
Yep.
Because they just simply look at it as, what is our risk on this lend? Okay, they judge you and your business, and they figure out, okay, how risky are you? And they look at things like how much cash does your company produce to pay off the debt that you've borrowed. That's kind of one of the things. But really, what they're thinking is, if this all goes wrong and everything goes to I don't know what an American term for this, but I'd call it tits up. But no, I don't know. Anyway, if things go sideways and it all goes to hell, what do they have as their fallback? Well, on a house, it makes sense because they take the house, right? And they can sell it. Whereas if they're financing your business, for instance, what is a bank going to do with assured security, right? It's like they don't know what they're doing. It's not easy to sell. So they're not going to lend as much because there's more risk perceived in if things go wrong.
Yeah.
So that's a fundamental kind of understanding of how this all comes together.
So I just want to kind of give some context to the examples that we just gave there. Just some quick math. If you were to borrow $1 million and you put 10% down, so that would be a $900,000 loan over a 30-year term with a 6.25 interest rate, you would actually be paying $1,094,923 to borrow that. So your total payback would be $1.994 million versus the $900,000 that you borrowed. So you would effectively be paying more than double over that 30-year term.
Yeah, and that's on a 30-year term.
Correct.
Right. And so lots of people will look at that and say, oh, well, that's crazy. We're paying double. But that's, that is looking at the interest rate and the cost over that period versus,
how much you could make off of it. Yeah. So in that theory, and that's why I wanted to kind of bring the calculation up here. So in that theory, you would be paying back, say, $5,500 a month over that period of time. So the question would be, with that initial investment of that $900,000, could you over 30 years make more than, on a return basis, more than that $1 million that you would have to pay back in interest? And if you could, then that's a smart use of leverage. If not, then, which I think is one of the challenges that a lot of small business owners have, is they borrow that $900,000, they commit to paying $1 million back in interest, but they make significantly less than that $1 million of interest to pay back over that period of time, in which case they start to accrue really bad debt.
Yeah, and that, I don't know how deep you want to get into this, but all debt is not equal. We're talking about, generally speaking, we're talking about simple and not like credit card debt.
Correct.
Obviously, has a different interest rate. I mean, I'm looking at this and I'm pulling up a calculator here, but I think kind of like the fundamental understanding is what I always refer back to in all these decisions is I look at what our business operates. Standard locksmith company, security company should make between 11 and 14%, right? That's pretty standard for small business in our industry. Your cost of borrowing should be, meaning if I go to the bank and get a loan for something, your cost of borrowing should be 3, 4, 5, 6% in that range, depending on what the collateral is, as we just discussed. So that means that the delta between, if you take that million and put it into your business, you should make about 11% or $110,000, and it should cost you about 60% or 60,000, which is 6%. So just simple math like that. I mean, that's not perfect, but at a high level, that would be well worth it.
Yeah, and I think another way to think about that too is, you can typically take money and put it in the stock market and make 8 to 10% year over year. It is proven. If you look at the historic index of S&P 500, if you put money in there and you keep it there, it is going to, on average, go 9 to 10% every single over the course of the year. So if you know you have a bucket of capital and you can put it in the stock market and take 10%, you can borrow money for typically a little bit less than that, assuming it's a good investment. Like you said, Lars, anywhere from 4 to 7%, 4 to 8%. You can take that money and borrow it and put it in the stock market and make a small return. That's probably not advisable unless you really know what you're doing.
Where does that fall flat?
Right.
It's because your return, you're not getting the cash because you still have to pay for that debt.
Correct. Yeah. From a business standpoint, you should be able to make more than that 10% in the stock market, because otherwise it's not worth investing in your business. You can just go take it and put it in the stock market. So like you said, Lars, you should be able to make that extra 15-ish, 20% in your business. And if you're borrowing for 7% and making 15%, you're making a return of 7.5%.
Double.
And so I think it's important to look at that, and that's probably minimum if you're going to be borrowing money. That you want to make sure you're making, but it's pretty. If you think about it simplistically, if you borrow at 1%, you need to make more percent, and then you need to determine is that worth it or not.
Yeah. So here's my question on that, because I love where you guys have explained that and helped to kind of get very granular. In order for all of those things to be true, how much do I need to be watching my actual margins in my business from a product and labor standpoint to know if that's actually profitable? Because my concern would be that you're just borrowing, if you're just borrowing to infuse cash into your business or to purchase something, but you aren't actually paying attention to your margins and your profits,
right? Then
how do you actually know that you've exceeded that delta, or you have that it was a smart liability to bring on?
So Tony, let me give you a couple scenarios to talk through just to make this a little more tangible. Okay. So the two most obvious ones: buying a company vehicle.
Okay.
Right. So you get a van. It's going to cost you $70,000. Okay. Should you pay with cash, or should you finance it from a bank? So that's scenario one. Scenario two, inventory. If you buy $100,000 worth of inventory, you'll save 10%. Is it worth buying the inventory in that lump sum of $100,000, or should you just buy it as needed? So let's try and talk, because those I think are two very realistic. And then buying a building, I think we can get into that one, but let's start with those two. Buying a van, Tone. What's your theory on that?
So that's actually one I don't have a good theory on, but I'll take a crack at it.
Cash or leverage.
Yeah. So I typically look at it as vehicles are a pretty secure asset from a bank standpoint, right? So typically when you go to a bank, you can get pretty good financing on a vehicle.
Yeah.
For the most of the time. Yeah. Well, not in the U.S., but
really? Okay.
No, typically in the U.S. it's been 6 to 8%.
Okay.
For commercial vehicles.
Okay.
At any rate, whatever the percentage is, typically because they have, like you talked about earlier, a literal asset that they have as collateral, you can get really good financing rates on a vehicle. The bank sees that as a pretty secure asset. So let's just say it's 6%. I know that every vehicle we put on the road returns more than 6%. To me, I see that as inexpensive cost of capital. So because it's such a secure financing, I typically try to borrow money against our vehicles, unless we have hordes of cash sitting around. That's a different story. But in a growing business, that typically isn't always the case. So I see that as pretty secure financing. So we try to borrow money on all of our vehicles to free up capital for other things that a bank might not see as secure. For example, inventory. a bank is there's value in there, but what's a bank going to do with inventory, right? There's no easy way for them to sell that.
Yeah.
If I wanted to borrow money on our inventory, they're probably going to give us a little higher interest rate.
And it's half. They'll if you have 100,000 worth of inventory, they'll lend you 50,000 as correct, because they're going to liquidate on it. Yeah.
To me, from a growing business standpoint, vehicles are a very secure asset, and you can get good interest rates with that. And because of that, we typically try to finance our vehicles to free up capital for other purchases.
Yeah. Because what do you get into the real numbers here? Like, okay, so a vehicle is 70 grand. Let's say it's 70 grand. Okay, so that's going to cost you, and they'll finance that over. We haven't touched on amortization versus term or any of that stuff, but maybe we'll jump to that later. But a vehicle, you'll probably get a 5-year. Is it a 5-year loan on a vehicle? So 70,000, 5 years. You're probably between 13 and 1,700 a month.
Yep.
Times 12, 24 times 5. Yeah, it's a little less than that. Probably $1,000 a month. Okay, so it's $1,000 a month for a vehicle. What do you expect that vehicle to produce?
Yeah. So
I just ran a numbers really quickly here. You're paying roughly $3,000 a year in interest to do that.
Yeah. Mm-hmm. Okay. So, and the cash flow, because that's interest plus principal, but it's going to cost you whatever about to buy a $70,000 van is about $12,000 a year. It's a little more, but
yeah. So you're paying $11,000 in interest over the course of 5 years.
Right, and that's again where cost versus cash flow. But if we're looking at it costs you $1,000 a month. You know that van's probably going to go out there and make you at minimum $1,000 a day.
Yep.
Right. That should be the revenue. Now, the profit on that should be about 70% if you're a service company, right? So you should be making a profit of about $700 a day minus whatever the wage is to put the guy in there. Okay. Very quickly, even if you pay the person in there half that, you're making a $300 or $400 per day on that vehicle. You can very quickly see that it costs you $1,000 a month and you're making $400 a day. That makes a lot of sense to me. To just leverage that up, you're making $1,500 a week. It's $6,000 a month on $1,000 investment. That to me is a no-brainer.
So I think this is a good scenario to run through with buying a van, and so I punched in a bunch of basically what you were saying into the chat here to see what kind of information it gave back. Because if you think about a business, say a $2 million revenue business, they're running at 10% net profit. Okay. Mm-hmm. And so the scenario that I put in here was I have a business, a $2 million annual revenue business. I've got about $200,000 in cash. I annually net about 10% of that revenue additionally. I need to buy a van that's $70,000. And that adding that van to my business will increase my revenue by around $350,000. So that's just the scenario that I gave it in there.
Sure.
And effectively what it's saying, what is kicking back is it very similar to what you guys are talking about. And I think the reason I think this is applicable is most businesses around that size, if I'm not mistaken, if they had $200,000 in cash and they were netting 10% annually, they would probably cash flow a new van.
Yes,
because they wouldn't want to incur the debt.
And right? I don't think there's going to be any businesses that have $200,000 cash with a $2 million in revenue. But
let's just say that they were very conservative and they were stacking cash. Like it's not unheard of, but
if it's a 30-year-old business, it's possible.
And so they may be sitting there going, okay, well, I would rather cash flow this rather than pay interest. Mm-hmm. Well, the couple of things that this information pulls out is one, in order to buy that van cash, you are reducing your liquidity by 35%, which is fairly substantial. And you are, let's see here.
65,000 of your 200, so it's about 33%. Sure.
Yep. And if you're netting 10% on your increase, then you've got a 4% delta between what you're borrowing versus what you're increasing every year. Plus, you're increasing your revenue. It makes sense to borrow that over time. Plus, interest is tax deductible in the States. I'm not sure what it is in Canada. Yeah. So, anyways, just kind of talking through that scenario because that's pretty practical. Yeah, I know for years our business, when we were sub 5 million, we expanded on a cash buy with vans. So we would not buy another van unless we had the cash to do it, which did a couple of things. One, it slowed our growth opportunity. And then when it did, when we did invest in that van, it hit us hard on cash and limited us from other things because it brought that liquidity out. So anyways, I think that's a good scenario to work off of.
Scenario, I think there's an interesting, I think there's two questions there. One, if you don't have the cash, should I take out a loan to buy this vehicle? Or if you do have the cash, should I take out this loan to buy this vehicle, right? There's kind of two different questions. I think like you said, some business owners will say, do I want to expand? And the only way I can expand is take on debt. Is that worth it? But I do think that, and I think that one is like the scenario you just outlined. I think the other scenario is, what if I have the cash? What if I have $400,000 of cash instead of $200,000? Should I then take out debt as well? And I think the question is, what else would you do with that money if you didn't buy this van? So I think there's should I expand with debt or should I expand with debt or cash? And depending on your cash situation, it's a different question. And I think
in that scenario that Chad just outlined, you have $200,000, $2 million. Would you buy the vehicle or would you finance it, and why?
I would finance it because I know that I can do. Back to my original statement, I know that that's a vehicle financing is cheap financing, and I have confidence that I can do more with that money. I can take the debt, and that's cheap financing, and I can do more with that money and investing it in business and things that I can't get financing on.
Right. What would you do with the $200,000?
I would invest in new employees. I would invest in facilities. Like again, a bank isn't going to give you capital to go hire new employees.
Right.
So
Not
I know
at the same rate.
I know a bank is going to give me capital to buy a vehicle. It's easy.
Exactly.
Because again, they have that asset to secure.
Yeah.
It is one of the easiest things to get financing on. And again, if you're trying to grow, you're going to need capital. So I want to leverage the assets that I can easily leverage.
Okay, so I want to kick the scenario a little differently. Similar situation, limited cash. I just got an approval for a 6-figure project, like we were talking about on kind of expanding into that larger project.
6 figures episode. Is that $100,000 or is that $1 million?
100.
$100,000. Okay,
yeah. Anywhere between 100 and 999,000.
$1 million is 7 figures, Lars.
Was that a? Gotcha. Okay.
Lars was trying to clarify. I was trying to be smart
salty.
To Lars. Yes.
Okay. So
you're in the penalty box, Tom. Mute yourself for 30 seconds.
This anybody that asks why we pick on Tony. There you go.
There he's gone.
He's muted himself. Okay.
His camera's off. Good.
Okay. Anyway, going back to that, what if I just got approval for a $100,000 plus project, and so I've got to purchase, let's just say $50,000. Let's just use the same number, $70,000 in inventory and products. So I don't. Should I do that with cash, or should I go borrow $70,000 to purchase that?
I would say that is an example of why you want to use financing for vehicles, because you want that cash reserve to do things like you're just asking. That is going to be a much harder thing to get borrowing on, because it's again less secure. So I think that is something that ideally I would fund with cash, because I wouldn't want to deal with the ebbs and flows, and it's a little bit harder to finance than just administratively. But yeah, so that's why that's a good example of why I'd want to keep cash around and try to leverage easier stuff. That's my opinion, at least.
Yeah. Now, all things being equal, I mean, the customer, that they're going to pay. There's the risk of bad debt is very low. Like, I'm assuming all of that. Where my brain goes immediately is, one, I would question the margins that you're working on. If it's 70,000, you're selling it for 100, but let's ignore that for the minute. But, I would look at, okay, well, I'd also, everything to me is about cash flow, leveraging cash flow. So if we're going to borrow 70 to make 100, I'm going to, first of all, be looking for a deposit. I'm then going to be looking at extending my payment terms with the distributor from 30 days to probably 60 days. And then after 60 days, I'm probably going to pay with a credit card, which gives me another 30 days. So I got 3 months to get that cash back. That's how my brain works, is I figure out how to make that work. But all of that aside, I would be looking at a leverage play on this. If I don't have the 70 in cash, I would be looking at a operating line of credit, which is something that, it's a point of pride that people say, oh, we've never used our operating line of credit. To me, that not using that operating line of credit just means you are spending too much on your cash. Mm-hmm. You are not leveraging it enough, because most of us in the industry, it's not a lack of business that is stifling our growth. It is people, processes, it's those things that cash can fix. Hiring more people, buying more vans, buying machines, figuring out how to make more efficiency. And that's what I would be using the cash for. Generally, I don't use an operating line of credit for a purchase like that scenario you just said, Chad, because I would use other levers to increase my cash position. Yeah. But I'm also different in that I grew up in a household where leverage and positive cash flow, debt didn't matter. It's leverage and positive cash flows we focus.
Yeah, I would say something there too is, this could be definitely controversial, but I think a lot of times people don't grow due to risk aversion, right? Like doing those things is risky.
It's risky. That's
yes,
the Tony.
No, but I think you have to have some tolerance for confidence in your business that you're going to be able to, like, you're in business because you make money. If you are good at what you do, you should be able to borrow and make more money with it. If you are not good at that, you are in the wrong business.
Okay, so summary there, because I just want to kind of take a breath and digest a little bit of what you guys are just talking about, because it is borrowing money when it makes sense.
Yes.
But borrowing for bad reasons, obviously, but that's a subjective statement, because borrowing against a bad purchase that is, one, not going to grow your revenue. So let's talk about that. I'm trying to think of a scenario that we can flip that on, because a short-term borrow to purchase hardware that you're going to resell and make profit on, and then be able to pay that back quickly, or as Lars just said, extending terms, using credit card to pay for it, all those types of things. That is getting yourself in a position where you're just kind of deferring the payment short term versus real borrowing, right?
What we're really trying to do is align when we're going to receive the money for the sale with when we're going to pay for it.
Yep.
That's the key to leveraging small business.
Yep. Which makes a lot of sense. And then you have the equipment or, real estate purchases, things that are going to be either revenue generating or long-term value generating that are going to appreciate over time. So, a van is going to depreciate, but it's going to allow you to generate additional revenue, where a building is going to stabilize your cost and also appreciate in value over a period of time, most likely.
Yeah. And I'd add there, and I think Tony talked about this earlier, but, really understanding the other side of this equation is, what else are you going to do with the cash? If you are in a $2 million business, I can tell you, like $2 million in revenue business, I can tell you right now with certainty, if you're in our industry, you have lots of runway to grow. There's way more business out there than you're probably not trying to actively find business. It's just coming to you. That means that adding some leverage, adding some more people is probably your best bet and best scenario. And financing vehicles, financing buildings, that kind of thing is probably your best bet. Now, if we turn to a business that's more established, and has $15 million in revenue, you eventually get to a point where, adding more people, adding more vans, you're probably going to see a diminished return, because you've probably gotten close to your what I'm going to call capacity of sales, your market share. So those are when you start stockpiling cash, and you don't have a lot of good options to use the cash. I mean, taking it out and buying a boat,
yes,
generally not a good use of cash. Now, you do get some utility from the boat, sure, you can argue that, but that's when when you think you've kind of got a large enough market share and you're not adding new products, you're not going into new locations, you're not doing anything new, it's just more of the same, that's when I start looking at buying a building. It took us 12 years to buy a building because I always knew if I borrow $1, I can turn it into $1.15. And we never had any cash because we were constantly buying more machines, more vans, more people, etc. Recently, we've got to that point where we're at a size that we're not seeing that 25% growth every year. So now I'm understanding that, we're probably getting close to, if we don't do anything different, we're not going to grow a whole bunch more. And now we're making cash. I decided it's time to buy a building.
So that's an interesting takeaway there, because I do think a lot of locksmith owners look to buy buildings. And my question there is, do you wish you would have bought one sooner?
No, because I look at appreciation of a building. If you want to look it up, Google cap rates for a building, and it'll tell you basically what your appreciation will be on a building. So commercial real estate in Calgary is about 2.5%. So if I buy a building, I'm going to appreciate my building at 2.5% every year on top, compounded. Well, I'm going to make between 11 and 15% on the business. So by buying a business, the cash that I have to put down, buying a building, the cash that I have to put down, which is probably $500,000, I'm losing about 9%, 9 and 13% on that $500,000. So it's actually costing me an additional, $70,000 or $80,000 per year on that building. So that was my kind of math of why it never made sense.
Well, and I think there's a testament to your confidence as a business owner there too, right? Like you knew what you could do with that capital in your business. I think a lot of times real estate is a very safe investment, but it has a lower return. I believe in America, the cap rate's around 8 to 9%. But
really?
It's still, yeah.
Wow.
But it's still it might be 5 to 8. It's definitely higher than 2.
Your cost of real estate is quite a bit lower than us.
Yes.
Yeah.
But again, so for a small business owner, sometimes real estate's a very safe investment.
Yeah.
But like you said, you might be leaving some money on the table. If you know what you're doing with running your business, you can take that, instead of making 8%, make 12%, 13%, 14%. So,
the one I was thinking of, because it's probably a little more tangible for the small business, that sub 3 million, we'll just say. We acquired a company, in Edmonton, and very granular here. They didn't have ITLs, or they didn't have code cutting key machines in their vans. So whenever they needed to make a key that, they would have to come to the shop or return or do something like that. And, you look at it and it's like, okay, well, that machine, that code cutting machine's $5,000 or $7,000, right? It's about that range. How much time are we spending? How much more efficiency effectively am I getting out of investing that $5,000 to $7,000? Right. And that's where a $7,000 key machine, we finance that. We go to the bank, we get a line of credit, or
equipment finance.
Yeah. Fixed rate credit facility, I think they call them here. And we take that and we finance it because it costs me $112 a month for the next 5 years.
Yeah.
And I know we're going to make that back in the first week.
Yeah. Plus, there's some depreciation around that as well. That is, to me, this is why the conversation, I think, is relevant, because I think most businesses in a $2 million range, $5 million range, would not, especially an ITL machine, would not finance it. They would cash flow it. And then that is, again, it's what is it holding you back from? So, like, the thing that keeps sticking out in my mind, and back to kind of Tony's question about would you have purchased a building sooner? I hate to look in that perspective, because it would have changed things drastically. Like if you were to buy something earlier, then you are going to be tying up your cash and your capital into a different investment vehicle, and it may limit your ability to grow at a certain rate. So. Would it have worked out in the long run? Maybe. It was just a different path to get there. Like, my big concern around that was we don't know how much space we need because we don't know what our growth trajectory is going to be over the next 7 years, like what it's going to actually shake out to be. So, yeah, but the kind of joke that I've said before is if we would have purchased a building 10 years ago, we would have purchased a 8,000 square foot building because that would have been double what we needed at that time. Yeah. Well, now where we are, we would be going, oh, what other building are we going to purchase because we're out of space?
Exactly. That was one of my mistakes. I mean, there's a list, but one of this mustache that I'm supporting right now, this haircut, those are on the list too.
It's top priority. Yeah,
it fits you very well.
But one of my mistakes, we bought the company 2012. We're in like a strip mall kind of setup, this little kind of dungy building that we'd made work. It'd be actually very similar, a less nice version of what you have, Chad. It's kind of, started this building and then you've expanded everywhere. Yeah. Right. So we did that. We found a nice piece of property, beautiful glass everywhere, just a way nicer place to work. Like, let's send 10-year, let's lock in the rate, very confident. Within a year and a half, it was way too small.
Yep.
I never, and it wasn't, we're a locksmith company, so I never considered the amount of space I need for administration, sales, for bodies, desks, that kind of thing. Yeah. So, within a year and a half, and now what we ended up doing is, we rented a couple other buildings. Now we spent a lot of time driving back and forth, and operationally it just sucks. Yeah. And the cost is double of what we anticipated. So that would be, I would agree with what you've said there. That would be something to strongly consider before buying a building. I'm not sure how liquid, meaning how easy it is to buy and sell buildings in your area, I would consider that. Yeah. But that was a huge miss on my part. So we didn't do it this time. The building we just bought, Chad, you've seen it. It's 2 stories. The intention is I'm going to lease out the top floor, and then when we need it, we'll start moving up there.
Yeah. So, but you have a size. You have a size of a company now that you can afford that investment, where 10 years ago you wouldn't have even had the ability to even consider a size.
And that's, you made me think of that earlier. Is real numbers here. It's going to cost us about $25,000 a month to service the debt. We bought a building. It's about $25,000 a month. Okay, so it's about a $3.5 million building. Okay, I look at that. For a locksmith in our area, let's call it $70,000. Okay, it's about $5,000 a month. That's not quite right, but $5,500 a month. So my cost to buy this building is about 4 locksmiths a month, the salary of 4 guys a month. So I'm basically saying that I think that my business isn't going to be effectively and efficiently able to use 4 locksmiths more per month. Yeah. And that's why I decided it's time to spend the money on the building. Because that made sense to me.
Yeah. So kind of going to some of the questions that I was trying to get is, one, that obviously when to invest in those types of things. And one of the reasons I want to try to draw this point back, if you are in a position where you have some cash and you're trying to decide, do I finance this van? Do I finance this equipment? Do I pay cash for it? Whatever. Also, I'm looking to purchase real estate or whatever. I would contend all those things are relevant to understand what your next 12-month trajectory is looking like, what your next 18-month is, because and I could be wrong on this, so you guys can correct me if I'm off. I don't think you can borrow money to put down on a real estate purchase. I think you have to have liquidity to be able to do that, correct? You don't borrow to borrow?
You generally can't borrow it from a creditor. Yeah. But you can borrow it pretty commonly from family. Yeah. Your parents, yourself, you can lend money to the company, that kind of thing. But generally a creditor will not, you can't go to one bank to borrow the $100,000 to put down.
One thing I will say with that is you can use existing real estate as down payments for future real estate.
Yes.
So
you can pull from equity from another building. Yes.
Yep. Yeah. So the reason I say that is if you were trying to do that, it to me, I think the lesson that I've learned over the past 5 years is protecting your cash for future large purchases by leveraging financing so that you are not eating away at that cash for something more substantial.
Correct.
Now, to your question both before, what are you going to, so you've accrued a certain amount of cash, what are you going to do with it?
Right.
And that's kind of the answer is, what is the ultimate purchase for it? What is the ultimate investment that you're going to utilize it for? And is it going to have a higher return than sitting in a money market account or a high interest savings account that you're actually generating more money off of?
Yeah. If cap rates in the US are 8-9%, meaning you're going to appreciate 8-9%, I would say real estate is an excellent investment.
No, I just looked. Industrial 7% and office is 9%. So 7 to 9. Yeah.
So that's, I mean, the relative risk of that versus operating a business.
Yep.
Golly, I would be buying buildings all day.
Yeah.
All day. That's
So it's more of more of an encompassing question of what is the return that is going to happen against that versus what else I would be using those dollars for, that cash. That's how you make the decision of if you're going to borrow or not. I lost everybody. Okay. Yes.
One other tangible example that Lars has shared with me in the past that I think is really good, and we've touched on this before, I think, but as far as acquisitions and buying businesses and using debt for that, I think a lot of times people get caught up on the price of the business. I'm going to buy this for $500,000.
Yeah,
it is. Lars mentioned this to me 5-7 years ago, and it was extremely valuable. Is the price of the business is not relative. The important factor is, what do you pay per month and how much will you make per month? And as long as you can cash flow that at 10 to 20% above your payment. So for example, if my payment is $1,000 a month, I want to be making sure that I'm getting back $1,200 a month. As long as you can do that and the business cash flows itself, that is a valuable purchase. And you can use debt from a bank, SBA lending, multiple different ways to finance an acquisition, but it is a really valuable way to use debt to grow your business, because the bank is going to see that business as a relatively secure investment, assuming they are profitable, and you can use that again as leverage to help you buy the business. You don't necessarily need $500,000 cash sitting around to go buy that business. The business has an income stream that is relatively predictable, and the more predictable it is, the better financing you can get. But when you're looking at buying a business, I think looking at what is the payment and the terms you need to get, and a lot of times you can negotiate that with the seller, and use that as a valuable way to leverage debt to buy a business.
Yeah, and I think, Jessica, two things. First, exactly what Tony was referring to. I will always say, if you want to sell your business to me, you can tell me how much. I'll pay you whatever you ask for, as long as I get to pick the time frame. Right? That was it. It's, you want $1 million? Sure. How does 25 years sound? It's like, oh, well, right, because there's just a trade-off between what you're paying for it versus how long. And I'm not going to get too far down that path. But Tony, you said 20% on your return. So if it costs you $1,000 to buy a business, you want to make $1,200.
Yeah.
So that number, 20%, that's the number that I've always used.
Yeah.
And just some explanation behind why 20% is, I look at, again, comes down to the very first thing we were talking about, risk versus reward. Okay, this is a new company. Excuse me. It's a new company. It's a new culture. It is considerably more risk than your own company, right?
Yeah.
And I know if I took that same money, put it into my own company, I'm going to make between 11 and 14%. Okay.
Yeah.
So that means to take on more risk, I'm going to want more return than the known risk that I have of 11 to 14%. Yep. So 20% is the number that I've just used. That's kind of my goal. And what I will do is I will look at it and say, 20% is what I'm willing to pay. So $1,000 plus I want to make a couple $100, and then try and make the business more efficient once I'm in there to, make it more profitable. So that's kind of the reasoning behind where the 20% come from.
My reasoning is that you told me that number 7 years ago and the logic sounded good, so I stuck with it. For once, you had sound logic. It was actually quite insightful. But another thing I'll say on that is that the risk is probably actually higher than 20%, but fortunately, the payment eventually will expire, and then all of a sudden it's all 100%. So you're kind of balancing that. At some point, it's going to be 100% return. Short term, it's 20%. The risk is actually probably higher than that.
Yeah. So simplification of everything that you guys just said, because I'm definitely not as smart or detailed as whatever you were just talking about. But simple conversation I had with one of my bankers probably 2 years ago, maybe a year ago. I had a small auto loan. This was personal, a small personal auto loan that I think I had an interest rate for let's just say 4.1%. 4.2% or something like that. And I had a money market investment account that I was earning 4.6% on. And so I asked him, I said, I've got the cash to be able to pay this loan off because, I had the cash in the money market. That
should I pay it off?
Cover this. And I said, should I pay this off? And he said, well, let's look at it. Your interest rate on your money market is 4.6 and you're paying 4.1 on the car. Mm-hmm. It is going to decrease. That interest value is going to decrease over time, and the rate in which you're going to earn on the money in the money market is going to outpace it. So there is no value in you, and unless you want to relieve yourself of the debt, there is no value in paying that debt off early. Let it pay itself out because you have the cash to cover it. And in the meantime, you will earn a few more dollars on the money in the money market account than you will than if you were to pay it off and then have to build that back.
Positive leverage, Chad.
Yeah, and that's the simplistic version of it. Mm-hmm. Now, we're doing this on a larger scale in a business, but the reason that I bring up that example is it was eye-opening to me to look at it in a simplistic term like that. So what areas of the business do we have cash that is generating more than the interest that we're paying on debt?
Yes.
So is that in a money market account? Is that in products and services that we're reselling versus amount that we're paying on a line of credit or a loan that we are trying to purchase vehicles or property or whatever? Just constantly monitoring that. Is my interest outpacing my profit?
Yep. Right.
And if that's the case, then I need to reallocate my debt percentage. But if I can keep my profit above my debt or my interest, then I can continue to manage that in a positive manner. Now, I think my takeaway of all the things you guys just have said today is being cautious in what I am using that borrowed money for.
Correct.
So
priority one. Yes.
If you're using it, and we use the topic of a boat, which is hilarious on so many different levels. One of which we just recently purchased a boat for the business because we were doing an install on a dock in Charleston. So we legitimately had to buy a boat. Anyways,
I hope it was a big boat.
No, it wasn't. And it was not one that we could utilize for anything other than floating in the river for an install.
Poor decision making there. Should have leveraged that opportunity for sure.
No, but hilarious. Yes, I got an email.
That's said, right near the top of the list. This mustache and that, what you just said, right at the top of the list of dumbest things that happened in 2025.
Anyway, point of it is not to buy it against something that is going to be a depreciating asset that you are going to outvalue. Now, I think our boat was a couple $100, so don't worry, no worries there. But we needed. It was just a little John boat.
That sounds like a raft.
Yeah, it was
a piece of plywood that floats.
Okay. Anyway, point of it is don't buy it against a depreciating asset that is not going to earn you money. So.
Correct.
A boat that's not going to earn you money, but a van that's a depreciating asset will allow you to generate more revenue. That's a whole different situation versus putting that money. And one of the things that I've seen that I would be concerned about is borrowing money with interest to purchase materials and then not having the adequate margins to be able to pay that debt back off in a timely manner. So you're accruing debt on materials that you've already sold that you don't have that as an asset anymore.
So one other area, because I've been sitting here and I've been preaching about leverage. Utilize leverage. Now, the part that I haven't touched on, I think is super important here, is talking about you need to have the discipline for paying this back. And this is where, I'm going to plug, Profit First. I think, I don't know where Chad's going, but he likes the word plug. But Profit First is a book that I read, and I said, this is the stupidest book I've ever read. Yeah, I think we've already talked about this.
Yes.
I remember this is exactly how I describe it every time. Terrible book. You should read it.
Yes.
Because it changes your mindset of how to structure this
discipline.
Debt. So it is the discipline. So for instance, if we are borrowing, we go back to that $70,000 project. You sold a $100,000 project. It's going to cost you $70,000. Okay. Where Profit First and the discipline comes from, it's based on the idea of scarcity. You can look at this in your own business. If you have one operating account and you have a whole bunch of money in that operating account, your expenses are going to go up because you don't notice them. When you started the business, you were probably going to the dollar store to buy your pens. Well, now you're probably, buying them at for significantly more expensive because it doesn't matter relative. A dollar is still a dollar, but it's relative. So if you are going down this leverage path, for instance, how I've set up my personal life is way better than the business, but I have a few different properties. So I have a mortgage, and each mortgage gets paid out of a different bank account. And those bank accounts get funded from my main account where I make, I get paid from work. Sure. And then it automatically transfers to each one of those accounts.
Yep.
So I got 3 different mortgages. It automatically moves there. And then, so now anytime I look at my, my main account that I can spend out of, I know how much money I have.
Right.
Because it's automated. I can't over leverage myself. I can't pay more because it all happens. And if you can set that up and get that mindset for your business, right, that will dramatically improve, or it'll dramatically reduce your chance of getting yourself into leverage problems.
So the 100% agree with what you're saying there, and I think from a personal perspective, if you figure out a way to mirror your business, and I have some really cool stories around that, but I don't think we have time today. But on the personal side, it's effectively the zero basis budget. So if you are bringing in, just for simple math, $1,000 a week, and you want to save $200, immediately upon deposit, $200 gets transferred to a savings account. $300 gets transferred over to a bill pay account, and then whatever you have left in there, which would be $500, right? $500 is left in your general account, and that's what you have to work with. But the typical human scenario is that you leave $1,000 in there and you mentally try to establish X amount for different bills, and then you overspend because you see the $1,000 sitting there versus the scarcity that is left in the account. And then you will get yourself into financial trouble. So from a business perspective, figuring out if it is that 10%, that 12%, whatever profit that you're looking for, if you take that off the top every week and put it into an offsite account that you cannot see, it will accrue over time. And the cool thing about that is, especially once you start to build some cash and you're putting in a money market account, then you can earn money on top of that. So it's earning while it's sitting. And then if it's out of sight, 6 months, 8 months later, you go look at it and go, oh, wow, we actually have something that we can go do these investments
buy
with.
A building with.
Yes. So those are all, okay, cool. Great insights today, guys. I really appreciate it. I think we are probably to the end of this particular conversation, and I have no idea who is next.
Are we long in the tooth?
Would be Lars.
Are you suggesting we're long in the tooth, Chad? Say the words.
The tooth has become long.
Oh, he used those words yesterday in a conversation with me. You would have been proud, Lars. He goes, oh, I hate to say this, but yeah.
Okay. Good. So we're going to be together at time of recording in less than a week. We'll all be together, and we're going to capture a couple of podcast recordings all in person, which I think are always fun because there's a lot more ability to get on Tony's nerves while we're sitting face to face. So we'll be doing that in Austin, Texas at the Brevo Eagle Eye Cloud Summit. So that should be fun. Who is going to be bringing the first topic at our recording time? Does anybody know?
That is Lars.
Oh, Lars. Oh, perfect. Yeah. He seems wildly prepared.
So, well, he's saying that one takeaway I got, or when he's thinking, one takeaway and one action item for people. The takeaway is a little analogy. I love analogies. I think debt is kind of like gasoline on a fire. It can have some benefit. It can help start the fire. It can help grow the fire. Too much gasoline can get out of control. So I would say just think of debt as a way to accelerate growth. And just be caution with putting on too much of it. And I think that's my kind of summary and key takeaway. And then a good action item, we talked about this, but just want to say it again. Go buy Rich Dad Poor Dad if you haven't read it, and read it. Lots of good fundamentals on debt and other things just related to personal finance. I read it a couple months ago, and it's a very famous book. If you haven't read it, definitely would encourage everyone to go buy it and read it. So,
agreed.
So hopefully that bought Lars some time to think of a next topic.
Well, I'm looking at our list of topics here, and I know as soon as I say this, you guys aren't going to like it. So I'm wondering, do we have a pause here so that you can edit this out and change it if you want? But it's right at the bottom of our list because it was something I added while we were in the MSC together. Do we want to talk more about money and profitability and cash flow, or is that too close to this topic?
I don't know. It's an important aspect. I think it's probably something that it is the uncomfortable conversation that nobody really wants to have. So I don't know that it's a terrible topic to discuss.
Yeah, well, it's the conversation that keeps coming up at the 2X conference is we make lots of money, but we're always broke.
Yeah,
right. And without actual visuals, I'm not sure how easy this is to do on a podcast is my challenge.
Yeah.
But, and I feel like I'm also going to get chastised as soon as we hit stop record. Tony, do you have a topic that you'd like to talk about instead of this? I'm giving you the chance right now on air, everyone listening.
So you're insinuating that at times Tony chastises you for a topic post-recording?
Listen, I would only chastise him because he puts zero preparation. Chad and I, we come prepared. We know what we're talking about. Even if we don't, we make it seem like we do. Every time you come,
you did spend a full 6 seconds on ChatGPT, and that was your preparation for this. I like coming in hot.
No, I mean, you think about the topic ahead of time. You know you're up. You should know you're up. There's a pretty similar cadence that we go through. But
so the answer to the question is he's just going to chastise you on the recording instead of post-recording.
Yes,
listen, if you want, that's the topic you want. I think that's a fine topic. I think,
be cautious how you answer this question, Tony.
Episodes
it's either that or the lessons of who, not how.
Oh, that's fabulous. That is a fabulous one. That is.
I think we're going to record several podcasts there, so we may be able to hit both of those.
So
people, hey, you know what? People will just have to come check us out to see where the next topic is.
Yes, let's start with the lessons of who, not how, and the changing the mindset of who, not how.
That's a great one. Love it.
Yep. Okay. Very cool. All right. So that's going to be the next topic of conversation. In the meantime, make sure you're subscribed so you don't miss that conversation. It's free of charge as of right now to subscribe to our podcast. You can do it on all the podcast platforms, Spotify, Apple, and whatever else is out there. You can find them on our website at unlockedpodcast.com. Thank you for your comments, your feedback on a weekly basis. Thank you to Aaron Beaver for putting the effort to try to make this look and sound a little better than it does on the origins. We appreciate
this. Is the better look. Oh, no.
Yeah. And so we'll see you hopefully in Austin, Texas. If you're listening to this, I think we'll be leaving.
They will be leaving by the time they listen.
So it was good to see. So on that note, it was good to see you in Austin, Texas, and we will see you next time right here on the Unlocked Podcast.